Hello, welcome traders. Today is Tuesday, August 13th, 2013, and I just wanted to give you a quick insight and update on a trade that was recently made. And it's my favorite trading strategy, specifically with options, and it has to do with Facebook. I bought some long-term calls, also known as LEAPs or long-term equity anticipation securities, a couple months ago. You can see the position right here. I did sell a lot today, but before we get into that, I just want to show you a time frame of where I purchased these options. So you can see here I had bought two and then another three the same day in July the 9th of 2013. So just over a month ago, I bought these at say $90 a contract. So 9 times 5 is 45, roughly $450. This trade right here of 5 contracts was purchased, and now this $500 trade or $450 trade is up over $2,000. And I'm going to explain that. I'm going to get into detail, but before I explain the strategy and give you all the technical and fundamental analysis behind it, I just want to give you some facts. So in order to do that, I'm going to open up my Leaps account just so that we can look at the account statement. And the account statement lets you look back at previously placed trades. So you can see here that if I categorize it by date, I sold out a lot of these contracts, the end of July and then also the last week or two. So you can see here that so far for the year, I'm up $9,432 in Facebook. And to give you further insight, I'm going to change the dates back to 60 and show you actually when I bought these options. So I think I have to actually go back 90. So you can see here that I bought 10 Facebook contracts. And I'm just going to talk out loud as I'm doing this. There we go. All right, here we go. Now this is all of the Facebook that I purchased. I had 25 contracts. You can see here, and these are the facts. Now this is just the one trade I want to talk about for right now. We can talk about Apple and First Solar and all the other ones later, but right now, since I closed out a majority of my position today, I want to explain it, and I want to give you the facts behind the trade. So May 2nd, 2013, I bought 10 Facebook January 2015 40 strike price call options at $2.14, which equates to about $2,150 for that leg of the trade. A month went by or so, and this trade was down about 50%. I was down about $1,000. And instead of panicking and selling, I knew I had, 2 years on the options. I bought more. I was still bullish long term. I liked what Facebook was doing. I still like what they're doing in the mobile department and how they're being able to monetize mobile. And furthermore, I have a strong knack for technical analysis, and I have very high instincts that Facebook in the next year or two is definitely going to retest their IPO price of $38 a share. So with that being said, let's talk some stock price numbers. And you can see here on the first execution date of May 2nd, let's pull up the chart and see where Facebook was trading. So you can see here, if I zoom in on the chart a little bit, May 2nd is right about here. So the stock was trading right around $27 to $28 when I filled the first 10 contracts of this trade. As you can see, after I filled it, it had a slow, nice little downtrend for several weeks, if not a month or two, to where it hit a low of $22 a share, give or take a few pennies here. So if I go back to my monitor tab, we can see here that I added to my position about a month and a half, say 2 months later, on June 24th. I bought 10 more contracts for 90 cents, which averages my cost basis down from $2.15 to roughly $1.40, $1.50 in that range. Simply just adding these two and dividing by 2, since I also bought the same amount of contracts. Now, furthermore, after June 24th, when I added to my position, I had 20 contracts. I bought 5 more July 9th. So that pretty much bought, and I know this off the top of my head because I stay on top of my trades, but I know that brought my average cost basis for these leaps down to about $1.40 a contract. So I had 25 calls at $1.40 a contract. just to give you the exact investment dollar amount, if I take 25 times 140, it's roughly $3,500. So this was a $3,500 investment, and this is the only trade that I've made on Facebook this year. And you can see that this $3,500 investment has equated into a $9,400 profit. So you can see that it's several hundred%. It's showing you right now my profit and loss percentage on my open position. But if I take the 3,500 and you make $10,000 off 3,500, I think it's safe to say that that's around 300%. So that's the trade. That's what I accumulated. And now that you have the numbers and the actual facts behind when I put the trade on and how I built a position as it was going against me, instead of panicking and selling and taking a loss, I added to it. And some people and professional traders might, say that you should never average down or add money to a losing position, but I have to say that I disagree to that methodology for one simple reason. Because when you're trading options, if you average down a position say it's down 50% and your options expire in a short time frame, like a month or 3 months or even 6 months, probably would not want to do that. It's probably smarter to find a better investment or trade to put your money to work. However, if you have a year or 2 years, like I had on this option, I think I had 580 days. You can see right now, if I go to my position tab, that you have 521 days until these expire. So at the time of when I added this trade on, it's safe to say that there was around 550, give or take, days until it expired. So when you have a year and a half on options, that's a lot of time, and a lot can happen in that duration. So adding or averaging down or adding to a losing position by buying the same contracts at a lower price point to bring your cost basis down, I think is a smart play, as long as you stay in line with your money management and your capital allocation principles. So today I actually sold, you can see here I sold 10 of my 25 contracts. I had sold 5 more after we had this huge pop about a week or two ago. So if I look I'm just looking at my positions here, my trade history for the last 150 days. But if I bought these 25 contracts at an average price of $1.40 between May 2nd and July 9th, well, I started selling the position out on July 26th at $4 a contract. So you can see that's already a pretty good profit right out of the gate. So between July 26th and today, the 13th of August, 2013, I pretty much scaled out of 80% of my position. So right now, I only have 5 contracts, and you're probably thinking, why did you sell out? If you have all this time left and you're up all this money, isn't it kind of free money? 2 things. Yes, it is. It is free money because this trade right here is only a $450 investment, and it's worth, the net liquidating value on the position is worth $2,600. So this trade is up $2,150 in profit. However, when you're trading and when you're managing your own investments, the worst thing that you can do, when you can easily avoid it, is to let your paper profits, or these gains that you haven't realized yet by selling, is to let them deteriorate or even turn into a break even or even a loss at sometimes. So taking profits when you're up this kind of money is very smart. I think that Facebook is going to still be higher than $37 or $38, which is today's closing price, in a year or 521 days from now. However, it's simply a money management game, and it's really goes back to technical analysis and fundamental analysis. But more importantly, when you're timing your trades, it's hard to time a trade based off of a news event or an earnings announcement or some new monetizing strategy. It's a lot easier to time your trades and make your buy and sell decisions off of a technical analysis standpoint, looking at a chart. So right here, this is a 1-year chart of Facebook, and you can see what it's done. The low of the year was 1755, and the high of the year, which it hit a couple of days ago, of 39.32. I mean, it shows you where you're at. So if you are looking at this chart, it's pretty safe to say that today we had a volume spike. You can see this gray bar. It spiked up and engulfed the last week with volume almost, and we had a pretty strong down day today when the market was up. I mean, Apple was up $22 today. The Nasdaq was up about 15 to 18 points. I didn't see where it closed out at, but I mean, yeah, we had a pretty solid day today. This is the futures right here. The NQs are up about 14, and now we have Facebook, which went down 3% today. I don't really like what I'm seeing there. So instead of sitting on the sidelines and watching all the thousands of dollars in profit, deteriorate, why not just sell out? Take your profit and buy back when it hits a good level or a more advantageous bullish standpoint. Right now, it looks like it could easily come back and test the 34 price range, which is where we have our moving average right here, a 30-day exponential moving average. And furthermore, we got some support right around 32, 33. So yeah, it's very conceivable that Facebook could come down, $4 or $5 in the next couple weeks or days or the next month for that matter. So I took a majority of the profit off. Looking back at today's fills, I didn't really do a lot of trading today, but I did sell 10 more of these January 2015 40 strike price call options. And I sold them out for $5.15, 5 of them, and the other 5 for $5.11. So if my average cost basis is $1.40 on that, if I take the midpoint between those, which is $5.13, and I subtract $1.40, my profit is about $3.70. Now, if you're new to options, $3.70 on a contract, you have to multiply it by 100 because every option contract is basically derived off of 100 shares of stock. So you multiply that number by 100. And that number multiplied by 100 is $373 profit per contract. Times 10 contracts, I mean, that was a $3,700 profit that I took today because of what I saw on the chart. Strictly unemotional decision. I didn't want to see a nice gain turn into a small gain or for that matter, I'd rather, watch my net liquidating value of my account go up once I make profits than watch it, come down when you can very, very easily get back in. So, I mean, just to say that, to close up here, I did sell out of these positions today, made a great profit, but it's very, very conceivable that I'm going to get back in, just get back in at a better price point. So if I can lock in roughly, across the board, probably a $4 profit per contract, right around, probably a little less, $3.90. But if I can lock in about $3.90 profit per contract times 25 contracts, well, that's about $9,700, which is where I'm at right now. Again, this is the only trade I've made this year on Facebook, and my profit for the year on it is $9,400. So I've made about $3.80 per contract. It'd be very, very easy to get back in if the stock comes back down to, say, 34. I can set an alert right now, which is what I'm going to do. And this is kind of how I trade and how professional traders look at the market. Is you can set an alert by, I get a text message or an email. When Facebook hits $34 a share, I'll be notified, so I don't have to stay in front of the screen all day, but I'll be notified and I'll be able to buy back these contracts for a cheaper price. Now, to give you an idea of what they might cost, I got to put in the right the right symbol here, but if I pull up Facebook, and again, this is the Analyze tab in Thinkorswim, which lets you analyze potential, prices and change of securities, options, and everything inside a risk profile, as we see here. So if I click on the January 2015 40 calls, I'm going to pull this up right here, and I'm going to uncheck everything because right now it's checking that I still have my open position of those 5 long contracts. But right now, I'm going to say that if, say, in the next 2 weeks, say by the end of August, say Facebook's trading at $34 a share, okay? And I bought these contracts today for $5.20. They would lose, I'm going to do 10 contracts, not one. 10 contracts, but they would lose $1,500. So kind of to flip the thought process around, if I can buy back these contracts when the stock hits 34, I can save $1,500. Might not sound like a lot to you, but if I can buy these back for $1.50 cheaper, makes sense to me. Yeah, I still have a bullish, long-term horizon, but I would much rather buy these back at 370 and then know that I booked a nice profit in between. It's very, very unlikely that I'm ever going to be able to buy back these contracts at 90 cents, which is where I got in down here when the stock was trading at $24, $25. But it could very, very easily come test 32, maybe even 30, as low as maybe 28. You have a lot of strong support in here. So the way that I look at it is, it's time to take your profit. You're up a lot of money. And this goes for anyone that trades long-term options or leaps, or even if you trade stocks. If you're up a good percentage on your investment, and you still are bullish long-term, but maybe bearish in the short term, don't sit on the sidelines. Utilize the technology and utilize the power of being a self-directed trader and investor, and let your money work for you, and use the tools at your disposal. So I'll very easily buy these back. Right, I'm only long 5 contracts now, which is basically a 250 long delta, which means I'm long 250 shares. It's the same thing. Very minimal theta decay. This is your theta minus this position loses $3 a day, which is very minimal. And then your gamma is your rate of change of your delta. So for every dollar Facebook goes up, my delta increases by 1260. Now, just wanted to give you a quick little snapshot on the Greeks if you're new to them. So that's pretty much it. I wanted to give you a overview of how you should approach the market if you're trading leaps, and how I approach the market, and how easy it is to get in the game, utilize the technology, learn the strategies, and just if you're new to this, don't panic. I know it probably looks very confusing navigating this type of platform, but if you want to learn, just stick with me. I would be so honored to help you and teach you and coach you to your online trading success. So till the next video, I will see you again soon, and thanks for stopping by.